Hey everyone, it is Evan here from the Trade Risk on Friday, December 28th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So today wraps up the 2018 final weekly close of the calendar year. Markets staged a little bit of a bounce back here in the second half of this week. We'll talk about that in just a moment. Stop the bleeding to the downside, but we have one trading session left in the calendar year 2018. That is on Monday, and then markets are closed on Tuesday for New Year's, so do keep that in mind. We have another holiday shortened week next week. Tuesday, equity markets are closed. Monday, last day of trading for 2018. So when we look here at our technicals dashboard, you can see we get a little bit of green showing up here as the market staged a bit of a relief rally here into the end of the week. We got some green right across the board in all the major indices. It is still a very bleak technical picture out there longer term. We're below all the key moving averages. We did reclaim last week's lows. We'll look at that in just a moment. And when we look here at some of the sectors, we are seeing more green across the board. Semiconductors, they've been at the top of the relative strength list over the past few weeks. They remain there. That is notable that they continue to, not to lead the market down anyway. That's a good sort of positive or interesting development there, or continuing development there in semiconductors. And when we look at some of the other major markets out there, key assets, we got silver at the top of the list here, getting a breakout from that range. We'll talk about that later in the video. Volatility certainly green, but off of the highs of this week. And on the downside, we have oil, energy, generally oil and natural gas here at the bottom of the relative strength major market. So let's jump into the charts now for the S&P 500 weekly time frame. This is the cash market. It's where we like to start our analysis. And you can see after 3 weeks of really getting pummeled here in the S&P 500, we finally staged a little bit of a relief rally this week. We are in fact, or we got as low as 2346 in the S&P 500. We closed the week at 2477. We got approximately a 6% bounce off of the lows. So a fairly meaningful bounce. I think at the highs probably closer to 7%, but where we finished is about 6% off of the lows. So a pretty meaningful bounce, but it does go to show you that, if you take 6% and you look back over any, past months, or even the past, year or two, 3 years in the market, that would have been a huge week, or a huge rally, a 6% sharp 4 or 5 day move. In this situation, because markets were just poleaxed so quickly, it really does not change the technical picture much at all. We still have sort of this new series of lower lows and lower highs on the weekly time frame. We've been slicing through support, and we're simply just getting a little bit of a retracement back into, the bottom quadrant of last week's trading. So for the S&P 500, it is certainly encouraging in the short term to see the bleeding stop, to stage a bounce from extremely oversold levels, but we still have lots of work cut out for us here in major U.S. markets as a whole. When we look here at some of the levels, 2330, this was a level, this was price action derived back from early 2017, in fact. So February, March, April, you can see the market staged about a 6 or 7 week pullback consolidation here, found some buyers stepping in around this 2330 level. We almost tagged it on Monday's sell-off earlier this week, but we did reverse a little bit in front of it, and we also reclaimed this 2415 level, which again was sort of a price action derived prior level of interest from mid to late 2017. So as it stands now, the market still below 2533. That was the February reference point. Were the old lows on the year at 2533. We do find ourselves below that and above some of this other longer term, slightly weaker, but notable prior levels to pay attention to. So when we look also at the weekly time frame here, you can see the MACD still racing to new lows here. So we still have momentum, which is making fresh new lows, which is not generally a good sign, right? It's generally still tells you that there should be caution out there, particularly on bounces, that sellers are still in control here. But like we say, it does depend on your time frame, and it is a good step in the right direction. If we look at volume a little bit closer here on the S&P 500, say or the SPY ETF now. Do note that, today, this week would have probably been the heaviest week we've seen recently, but we were closed a day and a half for Christmas Eve. So we had a lot less trading time on our hands this week, but volume, you can see, still well above average. Probably would have came in pretty close to what we did last week, maybe even eclipsed it, particularly with the snowball of selling that we had early in the week, which I think saved us in the fact that we did close down the markets for a day and a half. Otherwise, I think Monday could have been, a pretty ugly session, even further, and higher volume, maybe that real capitulation volume that we all probably would have loved to see happen. But as it stands, volume still pretty heavy even on the shortened week. So let's now go to a daily chart of the S&P 500, and you can see here we got this nice strong day on Wednesday of this week. We had a 5% rally, one of the largest moves. I think it was the largest move for the Dow ever in points terms, and certainly in the top, I'm sure 20, 25, 30 days, 5% move for the market doesn't happen all that often. So this was an impressive day. We talked about, in last week's video, if you watch that, the clues as to when the sell-off or when this panic, when this drop would sort of, start to wane or start to weaken, and when the coast would sort of be clear. And we're talking very much for the short-term active traders that are really watching this on an acute day-to-day, hour-to-hour basis. And the first thing we said is look for a day where we don't break the prior day's lows. And that happened on Wednesday, where we finally, we tried to sell off, but in fact, we didn't really break at all. Came down and basically tagged it to the penny, but we didn't break Monday's lows on Wednesday when we opened back up after the holiday. And we said the next clue would be, when can we take out a prior day's highs? That would be the next clue of sort of strength when buyers are starting to kind of step into the market. And that also happened on Wednesday. And, those were sort of your first signs of, okay, something has changed here. The selling has at least stopped in the near term. And it's something to pay attention to. And if you're active, if you're, really tactical, you might be able to capitalize on it. The third thing we talked about was the trend line. The steep level of decline that we were falling at. If we can start to take out the trend line, that would be another clue of the short-term kind of bounce of when it could get underway. And we essentially saw all that unfold this week, mostly on Wednesday. Saw some continuation Thursday, and a little bit of reluctance here into the week. So as we talked about at the beginning of the video, we did get a, call it 6% rally. Actually, in fact, to the highs of today, or the highs of Friday's trading, it was about almost 7.5% rally. So quite an impressive move in just 3 days' time. You can see we didn't close all the way at those highs, and we did close near the lows of the session. Go back to the SPY ETF, because I know a lot of people like to look at these levels. We did close around, under 248 red on the day. So what's interesting here now is whether or not this bounce has just run its course. That is something you have to think about heading into next week. Or, if you were playing for this bounce, a 5% day, tacked on with another, 1%, and then an intraday 1% the next day, 7% move, that might be all we get for this first bounce here. So again, not predicting, not saying that is going to happen, but we just need to keep an open mind that with very sharp momentum and breakdowns to the downside, yes, the rallies will be sharp. They certainly are, as we could see on Wednesday, Thursday sessions. But, we may not get, a bigger bounce up to 260 or, north of that like everybody wants. This may be it. And, if we start to head back down to these lows, that could be where the real panic sets in. Again, not a prediction, just keeping an open mind. On the flip side, if we do continue with this rally higher, the next logical spot to really pay attention to is around 260. That is where we had a lot of prior supply in here back in March and April of 2018. It's arguably where the big breakdown started to occur here just 2 weeks ago, around this 260 level where the selling and volume really picked back up. And maybe it's a check back up into that level. So lots of things to look at. You had this minor, well, you have the prior year-to-date lows in February right down here at 252.92. So again, that was about another point or two above Friday's highs. So you got kind of a lot of levels to pay attention to if this market can continue to bounce. I would say, stick with the trend in the short term. You'd have to dial it down to an intraday chart and, measure the trend at which we are now bouncing at. If that starts to roll over, if we start to take out a prior day's lows, you got to be cautious here because we are in the context of a strong downtrend. So remember, protect yourself. It's not an easy environment. If it's not suited for you, cash is always a great position to be in. That's sort of the way I would approach it. But, looking ahead, essentially looking acutely at Friday's highs here. Friday's highs right around 251.38. Now you have the big reference point down here on Wednesday's lows around 233. I'm sorry, Monday's lows around 233, just under 234. And then you have the up here around 260. I think those are the levels you can frame out the market, start to measure where it is, measure that trend line. And if you're tactical, if you're active, these are the people I'm speaking to at this point, then that's what you should be paying attention to. So that is the S&P 500 in a nutshell. I think it's still time to be cautious, enjoy the bounce. You can participate in it, trail those stop ups. Just don't think that the bottom is in. Don't get complacent as the market starts to move higher here, and do understand that ranges have certainly picked back up. Let me just look over my notes here. I think that is pretty much everything I wanted to say about the S&P 500. If we look at the VIX, you can see that also came off here into the end of the week, still pretty elevated, right? Still hanging not quite above 30. We're at 28. We're down from a high of 36. So we almost got as high into the February. I mean, February was, an interesting setup because we did have some of the volatility products blowing up, but we got as high as 50 there, but most of the action kind of getting and eclipsing and trading up to around this upper 30s area. So we basically got there on this latest move as well. We're starting to retreat a little bit, but it's still quite elevated. So let's still be cautious out there and be mindful of risk in both directions, shorting or getting long here. I think both are interesting cases in themselves. So that is the S&P 500. Let's go to the IWM. So the IWM here, also, if we look here, I'll switch over to this view, 126. So it tagged this pretty beautifully. If we go back on the chart here, again, it's not an exact level, but it's more or less where the consolidation took place, the highs in 2015. There was a lot of supply traded around this 126 level. It kept a lid on the market. It's arguably where we broke out from back on election time, late 2016, where we had this big kind of, high volume move over this level, 10% week in the Russell 2000 on this time above this level. So you could say from a longer term basis that we came back and sort of retested the 2015-2016 breakout. That is where we found the bounce. This, of course, is the market Russell 2000 that led us lower. It is also the most beaten up and negative on the year for the major averages. So it is, seeing a nice kind of 3.5% rally this week, reclaim last week's lows. Again, volume, it's tough to look at on a weekly basis because markets were closed for a day and a half, but it kind of ran right in here, and it definitely did still lose some steam. It did close green on the session, but well off of the highs. Same notes apply here. The same short-term levels. First step was holding a prior day's lows. Next step was taking out a prior day's highs. Next step, taking down this trend line here. We did checked all those boxes this week. We did get a nice little bounce here. We are starting to stall a little bit. So again, you just have to remember that if you're playing this bounce, you need to make sure you're playing it tactically and you understand where your risk is, because if we do roll back over, this could be in a very tough spot. So Russell 2000, be interesting to see how this unfolds, how all these markets unfold next week. We did participate in this trade on IWM on Wednesday. We got long here on Wednesday as it started to rally above today's close, and we got stopped out. You could thank me for the lows of the session here. Basically got stopped out, or trailed stop on Thursday as the market pulled back about 3%, essentially getting stopped out exactly where we got in here from that swing trade that we put on. Talked about it on Wednesday's video. No longer have that position on. I always like to, if I ever have a position on here in any of the instruments we talk about, always like to disclose that, of course. We have no position on anymore in the Russell 2000. Got totally juked out of this one and missed the nice rally here in the end of the hour session for the Russell 2000. So quite unfortunate unfortunate, but be interesting to see how this unfolds into next week. NASDAQ 100 here, you can see also getting that nice bounce, reclaiming some of these prior levels. This is still the best performing on a relative basis of the major U.S. averages here. It is down approximately it's I think 4 or 5% now. So a little bit of a outperformer here for actually the Qs. Let me see. I'm going to walk that back here. Let me just correct myself. So the Qs are actually only down 1.8%. So pretty impressive there. But the NASDAQ composite, the actual NASDAQ composite, down 4.62%. So that's those are sort of the numbers there on the year. But when we look here at the Qs, again, very similar situation. We got the nice kind of hold of the prior day's lows. We took out the prior day's highs. We got a nice rally in place. Let's see if this can get more legs behind it next week, or if we start to roll back over. So that is sort of that is, I think, all of the thoughts. A little long-winded, but markets have picked up, and kind of covering all those time frames takes some time. So that's the major markets there. Let's go into some of the others here. We'll go to TLT next, which on the week here was up slightly, 0.27%. Continue to see the nice green bars coming in here in terms of volume and price action, frankly. It is holding up. It is resilient. Bulls here in control in the short to intermediate term now. We're above 117. So long as we are above that, I do want to remain at least encouraging or optimistic in the sense that this trend can ideally last and continue to persist. We talked about the idea of bonds being a safety haven as turmoil kind of wreaks havoc on the equity markets. So if that continues to happen, if we do see a rollover in equities next week, then I would expect TLT to still fare pretty well and stay pretty nicely bid. We are coming into some major resistance, so as a trader, it's tough to certainly want to buy into all of these highs here. But for now, bulls are in control. If we go to oil next, oil here on the week was down just slightly. You can see here trying to stabilize from last week's beat down that it received. You can see we're still getting some positive momentum here in the MACD on the daily chart. We have 2 inside sessions here. So we had this very large range on Wednesday. We're getting nice and tight now. So for USO, for your tactical traders, going to look for some opportunity here as this starts to resolve itself out of these inside sessions. We'll see if this is counter trend and we can start to head higher, or if this in fact just leads to more pain and a rollover into the end of the year. Speaking of pain, natural gas still in some pain here. Ever since breaking down back on mid-December, this has continued to pull back. It's almost putting in a full retracement from the epic squeeze, epic move it had throughout the month of November. It is almost round-tripped back and retesting sort of these old levels here. Natural gas still in a world of of a sliding world of pain here over the recent week or two. Really need to get this back over 30 or so to start to look constructive. If you're looking for a retest, it's an interesting lower risk spot, but it certainly has given up all of that momentum from the prior month. So those, I think, cover, that's the metals. If we go to gold next, on the week, up 2%. So some continued not only strength but volume coming into metals here. GLD looking stronger and stronger every day, every week that we chart this now. It is working itself back into the upper end of the range, or the midpoint of the range from 2018. We're seeing good volume come in here on the daily chart. It does seem to be a little extended in the short term here. The trend is quite steep in the very, very short term that it's been rising, but it is seeing some good rotation there. Metals, MACD is making new highs here over the October levels, so it is encouraging developments all around in GLD. And silver, equally as impressive. We did get this breakout of this $14 range. This has been going sideways for about 5 or so months. It broke out, heavy volume, it's holding the gains. MACD's leading higher here, so great developments all around for silver and gold in both of this week and into the end of the year. So finally, let's look at some of the sectors now, individual sectors of the market. We'll look at the top 3, bottom 3. Top 3, or number 1 spot, is semiconductors. Semiconductors has been in the kind of top relative strength chart over the past couple of weeks, and frankly, this was one of the first to break down, or it was in the early stages of the breakdown, but it's quickly recovering here, and it really, over this last leg, I mean, you could look here, it's almost back to the lows from October and November when it was in this range. So it didn't really extend itself too far on this latest breakdown. breakdown. It covered good ground this week, almost 5% to the upside here. So pretty interesting developments there. Ideally for me, if this thing back above 90 would be a pretty encouraging sign for the market overall. If it can get back up there, there's quite a bit of overhead supply to contend with. It still looks like it could be a bear flag here, so it's certainly caution is advised, but just out of the basket of bad things, semiconductors is one of the the lesser bad that we can look at. Consumer discretionary, number 2 this week, up 1.71% on the week. Pretty sharp V-shaped type of rally. $92, retested the 2017 highs, the breakout level to perfection. It slightly just undercut it briefly and then saw a nice sharp bounce higher here. Lots of overhead supply. I mean, it had a pretty extended move to the downside, kind of this big two-legged move here and breakdown of this range in November. It is bouncing back here. Still, of course, caution is advised, but nice sharp rally. And materials here bouncing, number 3 on the week, 1.5% to the upside. You can see getting back towards the October lows. Still looks like it's in a pretty tough spot, but we did see a good amount of sort of capitulative volume coming in here over the recent days and weeks. Still is a tough one for me to want to get my hands around. XLU, worst performer this week, 3% to the downside. Saw a really big volume come in here as this broke trend line, as this broke a couple of horizontal levels here over this recent time. It did do a quick recovery of the October lows here, September-October lows, $52. It did stage this nice bounce. Good volume is coming in here, but there's quite a big exodus on this latest move down. So it looks like it's going to at least need some time to repair itself. 3%, pretty good to the downside there for utilities anyway. Staples, number 2 on the worst performers this week. Similar to Staples, we saw just this big kind of haircut in consumer staples stocks here. High volume coming in, breaking and slicing right through all of these prior levels and trend lines. We got all the way back to the May levels here of 2018. Notably, though, it basically held the year-to-date lows from May in Staples, and it is bouncing back here. So could stage a little bit more of a rally, but it's kind of a tough spot. And energy third worst. I mean, it's basically flat here on the week, just down slightly. We did see some good volume. This thing was really beaten up here over the past 2 weeks of trading. Not a ton of volume coming in on this relief rally, but a little bit kind of bucking the trend here. Still is in a very, very tough spot, but lots of these names are pretty stretched to the downside. So a little bit of mean reversion here is just part of market structure. It's just to be expected. So not much to like. I think once this bounce runs its course, I'd be cautious there in energy. So that is it. I think I got everything covered. Looking over my notes, I think that's it. So hopefully, we are prepared and ready for 2019. It definitely looks like we have a different animal of a market ahead of us. A different playbook, I think, is what it's going to require, but we'll see how things fare. We'll take it one day at a time, 1 week at a time, and we'll see if we can get through it. So thanks so much, as always, for watching. You can subscribe on YouTube, follow us on the Trade Risk blog. Either way, every Tuesday and Friday with these videos. Thanks so much, and talk to you guys next week.